This conference will now be recorded.
All right, so let's talk about SPX. Okay, so if I'm going to maximize the time frame, let's take like maximum available. If you notice this, I posted this on Twitter as well. Our 2000 highs is 1517 and 1530. 2007 highs is around 1535, 1555. And you have currently our monthly broke this long-term trend line. Okay, it broke this trend line, and the 50 moving day average for the monthly is 2595. I would say 2600. So if we can close March above 2600, then we'll likely go and test this lows 27, 28, 27, 11, and then we'll probably go and test, this mark, which is 28, 2900, this area. Okay, 2846. The lows of this is 2822, 2846. Okay, so but if we don't close above 2600 in March, then the first few days, the next week, and the first week of March would be important. But otherwise, we are heading back down to 2121 or 2134. This is 2014, 2016 highs, and then possibly to the lows of 2014, 2016, which is 1812 and 1820, which also coincides close to your 200 moving average on monthly, which meets around, your 2007 highs and 2001 highs. Okay, so that's this spot is really important. So we have, if you take a look at it, 2001, 2000, the dot-com bubble, we broke down, and we came back up in 2007, and we broke down, then we came back up. We technically did not do a back test of this area at all. So if you take a look at this, you don't see any back test at all of 1550, 1500 areas. So if the COVID situation goes bad, and if they don't get things under control in April, if we don't find any drugs that can solve that issue of COVID, then you'll see, things going a little bad. I'm not trying to scare you, but these are the possibilities that you might want to keep in mind, and that will go back and test these 2007 or dot-com bubble highs. Okay, and that's really good. If that happens, it's good in terms of investment, because for long term, this is a good spot to go long, and you can. It's going to give you opportunities where you can double, triple, or make in 5, 10 folds in years down the line. Okay, but again, if that situation happens, then that basically means that we are in recession. The world economy might take a big hit. Things are not under control, so there's a possibility of Great Depression to happen, right? And the last time when Great Depression happened was in 1929 to 1932, which is it's not here actually. So I'll post a chart on that. It happened in 1929 to 1939. So it went for like 10 years. But let's not move forward that far, but let's actually start taking it one step at a time. We have done good since, we have done extremely good since October last year till now. Okay, we have we've had great plays, and we have loaded good, and I've seen a lot of traders have actually improved and learned from this. So this is SPX. Okay, let's take Nasdaq. So if you take a look at Nasdaq, it's better than SPX in terms of it actually is holding the 21 moving average, whereas if you take a look at SPX, it's way below 50 moving average. Take a look at SPX, it's below 50 moving average. Okay, so Nasdaq is strong. Amazon has been holding, Apple has been holding comparatively much better. So again, it's not even tagged a 50 moving average compared to SPX. So this is pretty strong. So if we if Nasdaq starts breaking down, that means technology sector is going to get impacted big time. Apple is one of the major ones, along with Amazon. If those two break down, you can expect SPX and Russell to go down way lower. So that's going to create a bigger short opportunity. But so this is something you want to keep in mind. So relate your Nasdaq, keep a tab on Nasdaq along with your SPX. If Nasdaq breaks down, you can short SPX and other technology sectors for push towards 50 and possibly 200 moving average. SPX possibly went to 100 moving average. Nasdaq has not even gone there. So the least I would expect Nasdaq to go to 49.71, which is 100 moving average. If you take a look at SPX, it hit 100 moving average. So that basically tells you that you have a lot of short opportunities for technology stocks to go possibly to 49, which is basically this support system, the support level. So that's going to be, this is what your support is going to be.
What's that red line? Which moving average is that?
This is 50 moving average.
Okay, thank you.
Okay. So 4709, right? So that's what I'm looking at of Nasdaq. So first spot is going to be this area, which needs to hold. Okay. And this again was 2018 lows, which again coincides with your 2016, 2018 in SPX as well. So your 6,160 or 5,900 is a key spot. If that breaks down, you have your 4,700s. Okay. So keep a tab on this. Normally I put a alert. So that way, you know, it's easier. This spot again was held. So this is the previous low on Nasdaq in recent times. So keep a tab on these things. Okay. Russell. Okay. I want to talk about Russell. RTY. Anyone knows the symbol for Russell on Thinkorswim? I can go to IWM. Okay, let's go to the ETFs of Russell. Okay, ignore these lines. Too many of them. Okay, so Russell is the weakest among all the indices. Okay, Russell 2000. So this has already broken and already touched 200 moving average. Okay, so this is the weakest. If this bounces, rest of the indices will also follow through. So this is a really good indicator. So I would use Russell as the first primary indicator for any weakness or any bounce. Okay, because following Russell, you'll see SPX, Dow Jones, Nasdaq, all of these will also bounce accordingly. Okay, and Russell is not even close to your 50 moving average. SPX is almost at 50 moving average. Nasdaq is above 50 moving. It's almost at 21 moving average, which is yellow line, and your Russell is below 100 moving average. Okay, so let me actually go to another tab. So if you take a look at this, your SPX, it's almost at 50 moving average. Okay, 25.95. It's below 25.95 right now. Okay, if you take a look at your Nasdaq, it's above 50 moving average. Clearly, it's one of the strongest because Apple, Amazon, the technology stocks are really holding up pretty good, and it's almost just below the 21 moving average. Okay, whereas if you notice your IWM, which is the ETF for Russell 2000, it is way below 100 moving average, and it's almost at 150. So I'm expecting this to see probably an inside month in April. If not, if it takes out the lows, it's going to go down way low and drag the other indices. So use Russell as a real-time indicator to actually, you know, guide you through this market. So watch that. If you get a bounce on this, you can expect SPX to go to 2711, 2800, 2846. If you see weakness on Russell, then expect SPX, Nasdaq to also break lower. Okay, so this is how you should gauge your market. Let's move to UVXY. Let's look at the daily. Okay, so if you take a look at the daily, all UVXY did from the lows of 10.4 in recent times, which was, I would say, let me tell you when it was, on February of 12th, okay, around that. And the highs it made in March 18, which is 1 month from there, it did a retracement up to 38.2. You can take it as 61.8 again, however you look at it, and it held that, okay? So all it did is backtest the 10 moving average, it broke that and backtest the 21 moving average, okay? So the last time it cleared and it backtested, it was lot before, okay? It was way before, below 200 moving average. It never did that for like more than 6 months, okay? So I'm expecting a possibility of bounce to 80. If we clear 80, then we can see 88 and 97. And then above that, we go back to 130 and 135. Above this, I have moved towards 212 and 151. Okay, so let's take this. Let me just show you this, the weeklies. Guys, please make sure you mute. Okay, so this is the pennant flag that it actually broke, which was since 2017. It broke below and then it went up higher, right? So let me just, guys, please mute. Okay, so this is the big pennant it broke, which was around February of 17. And then after that, it kept going up. Okay, so this is the next spot, which I already hit 95. Above this was this 112, we hit that. The next one is 150.9. Okay, this is where I'm looking at Russell going towards. Sorry, UVXY. So expect UVXY to go to 151, and if that clears, then we have moved towards 200, and then 228. Okay, which is basically almost coincides. 212 coincides with this 161.8 fibs. Okay, so UVXY, we took a. I wanted to talk about the call spread, but look at this. Low volume pullback. Okay, it was up higher, it went higher, and then it retraced in last but 1 week, which is March 16th week, and then it retraced last week. So low volume pullback, and it went high on volume. It broke out on heavy volume, which is 298 million, 223 million, 138, and then 100 million. So now we can, if we dip back, then we can possibly see this area, which is 27, 23, and then bounce from there. So next week is crucial. It's holding the weekly 115 moving average, and it's holding about 38.2. So this 59 and below is important, which is basically also the close of one of the weeks. 57 is the important number. So if it closes below 57 this week, then possibly we'll go test the 46 level and then probably go a lot lower. Okay, so use this, but if it closes above 88.50 this week, then you can expect a move towards 108 and 135. And we took a call spread on that. I'll talk about the UVXY a little later on that spread and why I took that play. Okay, WIX, same thing. It moves in tandem with UVXY, VXX, everything. So, but WIX held stronger. WIX bounced. That means there's a lot of fear in the market still, and it held 61.8. So next week, if we clear 77, 78, then we can see 85, and then above that we have moved towards 124. Okay, so keep a watch on these things, and yeah, I think these were one of the things I want to talk about. We'll go through the charts later. Let's look at the internals. In recent times, the ticks have not been that helpful because they've just been sideways, a few spikes here and there. I mean, I do use 15 minutes on ticks, right? So whenever we gap up or gap down, we'll see a huge spike, Okay, it's either going to be below minus 1,000 or above 1,000. Okay, but the advanced decline volume has been really helpful. I've been using these a lot. Anytime we see a gap, it's either, so we see a gap down, it either fades or most of the time it will actually reverse and go up. Okay, every gap down, that's what it's done. Okay, so let's take, sorry, that's why it's 15 minutes. Okay, here it is. This is a better view. Look at this. Let me increase the time frame. So, okay, so if you take a look at this, this has been a support line, this white line, and this has been the resistance line. Okay, it's every time it hits this, it gaps down, it pulls back, pulls back, pulls back. So let me just see this, pulls back here, pulls back. Every single time it does that. So it basically helps you to navigate your your trading, right? Every time. But what happened after February, mid of February or in March? It started breaking this resistance. It started going up above it and create a new set of resistance level, which is this dotted lines. Okay. So now what it does, it basically gaps up, or it goes, gaps above this white resistance line and goes and touches the dotted resistance line. Okay. And every time it is gapped above this, like here, it's gapped down. But otherwise, when it hits these resistance, like if you take a look at this, it hits the resistance, it pulls back. So during this spot, you can start looking at shorting the market. Okay, it's pretty easy. And then it comes down to this support level and this another dotted line support level. And then again, it bounces again and down. So if it gaps down, it goes straight down to this support. But if it breaks that, then it goes to a secondary support level. Okay, so that's how I use my internals. It's been pretty helpful in navigating the market. So last Friday we gapped down completely, and then all day we rose up until the last half an hour of the day we pushed back. Last 15-20 minutes we pushed back. Okay, so again, now Monday is crucial. So we'll have to see either if it gaps down, then there's a good possibility we'll bounce, or if it gaps up, then we have to watch the first hour whether it fades or it continues up towards this resistance level, which I can just do an extension, which is this resistance level, or further than that. Okay, so this is how I use the internals to navigate the market. It's pretty useful. It's worked for me. You guys can try it out, see how it does for your system, and we'll see. Okay, so how do you maximize the profits? Okay, so we talked about the indices, we talked about the overall market. I've already explained so many times that the COVID situation is what's going to keep driving the market, and we don't know how soon that's going to get sorted. So I'm crossing my fingers and I'm hoping that in April, Gilead, Regeneron, Moderna Incorporation, there are so many other companies that are working on on drugs to cure this virus. And if we get lucky, and if we find the cure, then you can pretty much say that a month from there you can keep a tab on the news, which will talk about reduction in number of infected people, reduction in number of deaths. So all this will be signs for you to look at, which will basically determine the bottom in the market. Okay, and then we can look at doing 6 months out or year out leap calls and everything and take advantage of those. But until I get the confirmation, I'm not just going to use technicals blindly and alone without the news, because if this is anything like recession or Great Depression, then things can go ugly for years. Okay, so I'm not trying to scare you, but I'm trying to give you these information so you are well prepared in advance, so you just don't blindly buy leaps or go long thinking that it is a V bottom or a W bottom, or you're going to get a crazy rally, etc., etc. Okay, there is a possibility that this year we might not even see the old highs. Okay, which was early in this February, 33.93 in SPX, right? 33.93. On Nasdaq it was 8,000. What is it? 9,700, right? There's a possibility we might not see this at all. If that happens, then you can expect we are going down further. So all this depends on the COVID situation and how things get under control. Okay. Now, let's talk about how you guys can maximize your profits. Okay. So I think it's probably important to address this because you want to take advantage of this. Now, there are three ways. The first is you can hold, when you're in a trade, you can hold this trade until the last target zone. Okay. So let's take examples. Okay. Let's take Boeing, for example. If I take Boeing, which was Boeing 135 calls. Sorry guys, I'm just going to scroll lower to find that Boeing play. Okay, I think this is the one. Yeah, Boeing. Okay, so let's take Boeing. Now, we took the Boeing 135 calls, March 27, which is weekly expiration, for $3, 3.2. And you had 7 target zones. Okay. Now, how do you maximize your profit here? Now, the first thing, you have to fine tune this system based on, what fits your personality. It's really important because if you're not the kind of person who has a bigger risk appetite or who's willing to be patiently wait for the trade to continue to work, then maybe you're the person who would like to take the profits early and then jump in again. Okay. So if you like to hold it longer, then you should evaluate your risk. You know that if you hold longer, there's a possibility that you might not hit the final target zone, which is 151, and you might lose all of your profits, or it might just close on the week at say 135. Okay, which might basically kill all of your profits. Okay, so if that fits for you, you want to hold it for longer, then you can do the step 1. Okay, you can just hold it longer. And most of the second way of doing this is you sell some and you lock your profits and your cost out. This is what I would recommend because one, your emotions are not going to get involved. When you look at your P&L and you look at it on Tuesday, Wednesday, when Boeing hit like $7, or it hit like on 24th 151, where our Boeing calls by $18-20. At that moment, which is 25th, which is like on Wednesday, we hit $18-20. And if you don't take the profits, there's a high possibility, when you're looking at your P&L, it will, and if you have 10 contracts, those would be worth like 20 grand. Okay. And you might end up like selling these emotionally. So what I recommend is sell and lock your cost out. So that way, what happens, you've locked, if you bought it at $3, you sold it at $6, that basically, if you sold half your size, you basically selling at $6, you basically took your cost out, your trade is free. Whether it works or not, it doesn't matter anymore. But if you decide to sell it like say at $8 or $10, then that means you logged a cost and a certain amount of profit. Okay, or that's what I would recommend. And then you ride the rest of the to the upper target zone, where you can stretch it out to see how far it can go. Okay, and use daily close as a stop or 4-hour close, depending on how long the expiration is. The third final way you could do, which is the best way to do it in such markets, is basically, you roll up. So you take profits in whichever target zone 1, 2, whichever target zone works for you, take profits accordingly and roll up to the next strike. Even if you buy in the money on the next strike, it's fine. Because if it is only 3 days left for the expiration in case of Boeing, which worked, 8 out of 10 times, you wouldn't see this happening. Okay, unless there is funds that are buying into a particular stock, or any kind of stimulus, or any kind of injection of by the Feds into the market. Okay, So basically, if you buy this, sell, and roll it up, so basically what happened? You bought it at $3, and let's say you sold it at you bought it at $3. Let's say uh, on 24th calls were at $7. You sold it at $7. Okay. So now you made a profit of $4. What you can do is you use those $4 profit, and you can buy the next strike or further out strike uh, using all of your $4 profit, or just using $2 of or $1, whatever you're comfortable with. So that way, on your initial trade, you logged your costs and profits, and now you're using part of your profits to buy the next strike and ride the trend. So this is how you can maximize your profits. This is how you can ride the trend and make sure that you're not missing and you're not leaving too much on the table. But I'll tell you one thing, right? 99% of the time, it's going to be really difficult for you to, hold your calls to hit the high of that particular trade, right? The highest premium, or if you're shorting that particular trade, the lowest premium with respect to that expiration. So that's not going to happen. The same thing. Let's take another example, right? Same thing goes with Zoom. We did this previous week. We had let's take the weekly Zoom, which was 118 calls. Okay. If you guys remember, we took the 118 calls as well. We had multiple layers of Zoom that we created. And let's see, where is that? So we see what we did here. We had the 118 calls, and then we took a roll-up idea. We rolled up into 127 calls. Okay. What happened? We logged profits in 118 calls. So it's really important that, look at this. This is your 118 calls. And these hit like $10. And it was basically March 20th, and March 18th is Wednesday. So you had 2 days left. In 2 days, Zoom on March 28th closed. Let's see, what price Zoom closed on March 28th. So March 28th, Zoom closed at it went high of 136. Okay. So 118 calls, if you would have held for next 2 days, you would have hit $18. But you can never predict that, right? That's the reason we took a 2.75. We logged it at 8.3. We scaled out, and then we rolled up into 127 calls. Okay. Same week expiration, which is next day expiration, and we rolled it up, used part of a profit from 2.5 to 8. That's like, $5 net profit or $4 net profit, because we've been scaling out in our profits in different target zones. So $4, that means you logged $1.50. You put back in 2.5 on 127, and you wrote it back to 6.3. Okay. So that's that. So again, right? This is what I'm trying to explain. So see what works for you. Okay. If you're the person who likes to take crazy risk, I know folks in our team on Friday as well. I think, was it Tally? If I don't know if he's on the call right now, but his methodology of trading last week, which he posted, was he took profits and he used 40, 50, 60% of those profits putting back into another trade. Okay. So that's the kind of risk he wants to take, right? So again, it depends what your risk appetite is. He fine-tuned the system according to his way, and it's worked for him. That's good, right? That's how it needs to be. So you need to, I provided you the TW rules, I provided you a system, I'm providing you the alerts, your entries, your exits, everything. All you need to do is see how you can maximize it, how you can fine-tune it by, following any of these 3 ways that fits your personality. Okay. Now, if you have time in expiration, the best thing is you can always try to hold it as long as possible. Okay. So if you take a look at Zoom, April 150 calls that we did, this was April 3rd, 150 calls, right? This had a lot of time because it was in March 16, 18. So we had like almost a week left, right? So this gave us an advantage. When you have an expiration time, it's worth using daily close or 4-hour close to take a stop. Okay, so that way you're giving yourself the opportunity to ride the trend even more longer on the same expiration, which you're already in it and making already profits on it. Okay, so this is important. Hope this actually clears a lot of ways of how you guys can maximize your profit. The next thing is how to take stops. It's really important, guys. I mean, I'm not trading for you guys. I'm not trading because there's so many of you guys. It's obviously not possible for me to sit and monitor every individual person's trade. You have to monitor it. You have to take the call. You have to take your entries and exits. Okay, but each time you take an exit, you take a profits out. Use the previous target zone as your stop, and use the closing price. I mean, you can use the premium. If the premium hits, you can use that as your closing price of that target zone, or you can use the stock closing price of that particular time frame. Whether you're comfortable with hourly, 4 hours, or whatever it is that you're comfortable with, use that. So it's really important that you raise your stops, because in this market, the volatility is really high, so you can easily get smacked. I mean, you can easily turn a profitable trade into a losing trade. And that's the last thing you want. Even if you make 30%, 50% on a trade, these profits will add up over a period of time. 30% in a trade today, if you take it, and if you have the entire week where you made 50% profits, that's 5 days of 50% gives you 250%. Okay, so small profits, or based on whatever your risk appetite is, fine tune the system according to that. Okay. There another way of actually handling stops, which is, when you're doing options on weekly expiration, okay, the premiums, they fluctuate a lot. So let's see if I can take an example, maybe Zoom. I can't go, okay, I don't think, let's click, okay, let's see. Daily. Okay, so what is it? March 16, 18, we took April 3rd, around that we took April 3rd Zoom 150 calls. Okay, so if you take a look at it, if you would have held this for longer, it hit $27 on March 23rd, but on 24th, these $27 became $7. Okay, because there was only 1 week of expiration left, and the premiums could actually fluctuate tremendously. So it's really important that when you're doing weeklies or bi-weeklies, you decide based on your stocks, or decide how you want to use your stocks. Okay, so if you actually the other way of handling your stops is you can use dollar amount as your stop. Okay, so if you're actually going to do dollar amount as your stops, the advantage of that is what happens is, instead of me, let's say you put a value, let's say you use $3,000 on a trade. Okay, that's your trading size. That's your normal size. That's what you use, $3,000. And you use a stop based on, like, okay, if I lose 50%, that's my stop. Okay, so instead of you buying for $3,000 on a trade, you buy for $1,500. Okay, what happens in that is you basically have set your mind that this is my stop, and I don't care if it goes to zero. So now your emotions are not involved, and that will make your trading even more objective. Okay, so when your emotions are not involved, you've already set your mind that, okay, $1,500, I'm using my stop as a buy-in trade, and I don't mind it going to zero. You're basically setting up an opportunity for yourself to let it see how far it can go till the expiration. And if it goes above and you make profit, you take your profits out and you carry on. Okay, now I know people who do that. I know people who actually use 30%, 50%, or 20%. They just have directly stops set on that basis. I use stop based on the stocks, the stock price value. Okay, so I use stop based on, okay, what is the where it is and where it has been, and I use 4 hours and or If it is a weekly expiration, I use 4 hours as my stop because I know it's less noisy and it's easier compared to using a 15 minutes or 30 minutes, because in this volatility, you will get stopped out. So you want to give little room to your stops. So hence using a closing price on an hourly or a 4 hour is much better. Okay. If you have expiration that is longer than say 2 weeks or month, 2-3 months, then use daily or use weekly as closing price as a stop. Don't look at, for example, Gilead. Okay. We are in Gilead Jan calls. Okay. Let me show you. We are in Gilead Jan calls. Let's see the value of Jan calls. I'll just take that. Okay. We are in Gilead Jan 90 calls and 100 calls. Okay. So we rolled up to 100, and the 100 calls are worth 3.8 right now. Okay. So why would you look at, we've already, and we hit $12. Okay, which was basically on March 19th. There was a news. We hit $12. We took our profits. We locked most of our profits. Now that particular trade is a free trade. Now, if you decide you want to use a daily close or a weekly close and stop it out, go ahead and do that. That's fine. There's nothing wrong in it. You can get back into it again. I have not used a stop because I thought, okay, Jan is a long way to go. It's almost 9 months left, 8 to 9 months, right? 8 to 9 months left. So I'm just holding it because it's a free trade. I don't care if it goes down. If Gilead goes down to 66, 64, which I've already told you guys, if it does, I'll buy again because 66 is 200 moving average. And if you take a look at the monthly, it's been holding it pretty well. So I'm just holding this because this is a speculative play based on the drug news. And the accumulation, look at this volume, 448 million, 554 million. There's news behind this. So that's the reason I've held on to it, because if they come out with a drug, that's successful drug that actually cures the virus, this stock will go back to, easily 112. It will go to 89 and it'll go to 112, 103, 112. So that's the reason I'm holding on to it, because I have 8-9 months of expiration. So you have to decide what works best for you. Nobody can decide that. Okay. If you're so that's why I keep saying that the system is there. You have to fine tune it based on how you like to trade. Okay. All right. So I think it's been 40 minutes. We've talked about indices. We talked about, how to maximize your profit and how to lock your profits. Okay. So let's move on. Let's talk about the trigger sheet. So what am I looking for the next 20 minutes for the next week? And then after that, we'll look at the futures and take some questions. Okay. So I've already talked about the SPY, SPX indices. I can talk about the QQQs. It broke this wedge. And, if the market decides to bounce, it'll go back to 208, 209, which is the, breakdown spot, or 204, 206? Yeah, 206. So it can go back and backtest this. So first spot would be 198, and then it's going to be 206, 205, 206. So it's broke down, right? So then 21 moving average is 186, which is below it right now. So the next month is pretty crucial. If we break this, we are going to head towards 157, which basically means your Apple, Amazon are going to go a lot lower. Okay, so you have to take a look at Apple. It's right now holding your 200 daily, 250, 249, just below it. So all you need is Apple to break down further. So it went to the lows of 228 and it broke below that as well recently. So if we actually keep going lower, below 228, it went to 212, something like that recently, right? Yeah, 212.61. Okay, so this is a pretty important spot. If we break this next time, which basically means we are breaking this support here. Then we are heading lower to this spot, which is 192, and then possibly the 50 moving average, which is basically 178. That's what I'm looking at a longer dated. Okay, so I talked about UVXY, Wix, Tesla. Tesla, it worked perfectly. Look at this trend line. It came here, back tested, held the 50 moving average on weeklies, and it bounced last week. Now it's hitting the resistance level here. So the key next week is we need to close above 560. We close above 560, Tesla is going to 653, 650, 653. Yep, that's 650, 650. Yep, that's where Tesla is going. So we can see 650 easily. So 560 is pretty important number next week. If we clear that, we can go to 594, 607, 650, 668. Those are the numbers I'm looking at Tesla. If you look at the dailies, it gives you a much better picture. We are hitting the resistance here. So short below 494, pulls it back to 460 and 420s. Above 526, you can add some long. Above 560, you can scale in further. Okay, so that's what I'm looking at Tesla. Zoom, we took a trade on last week. I should actually go it this way. So it broke this pennant. This is what Zoom has done. It broke this pennant. It looks good. Volume came in on Friday, which is 13.2 compared to Thursday and Wednesday, right? So if we break above 155 next week, then this runs to 165. I'm bullish on Zoom. 182 is upside, and above that is 234. So we took the play we took is a call spread, right? You guys know it. That's 155 and 180 call spread. The reason I took is I had 261.8 as a fib resistance at 182. So 155 to 180 is $25. We paid what, $7? So that's 200% return.